The way we're going to do this is we'd like to start out by introducing the moderators. And for our first introduction, I'll ask Lauren Rudin, a member of the current Portfolio Practicum class, to come up.
Hi guys, our first moderator is John McGinn. He's a CFA charter holder and is president of McGinn Associates, a financial consulting firm located in Omaha. Mr. McGinn retired from Mutual of Omaha in 2000, where he was executive vice president, chief investment officer, and treasurer. He was also the president of Mutual Asset Management Company. Mr. McGinn has a BSBA degree from Creighton University and a master's degree in finance from the University of Minnesota. Mr. McGinn is a former chairman of the Board of Governors of the Association for Investment Management Research, now known as the CFA Institute. A past chairman of the Board of Trustees of the Institute of Chartered Financial Analysts, and a former chairman of the Chief Investment Officers section of the American Council of Life Insurers. He is the author of several articles and the co-editor of Managing Investment Portfolios, now in its 3rd edition. Mr. McGinn serves on the board of Nebraska Investment Council and the investment committees of several endowment funds, and is a director of 3 foundations and 1 corporation. He is also an adjunct faculty member of the Heider College of Business at Creighton University in Omaha, where he teaches a graduate course in investments. Please, everybody, help me give Mr. McGinn a warm welcome.
And our other moderator, Dr. Robert Johnson, is the president and CEO of the American College of Financial Services, an accredited degree granting educational institution located in Pennsylvania. Dr. Johnson previously taught at Creighton as a full professor in the Heider College of Business, where he established a portfolio practicum program. From 1996 to 2012, he held a number of senior executive positions at CFA Institute and has extensive experience with credentialing programs, ethical and professional codes of conduct, and global business expansion. Dr. Johnson has a BSBA from the University of Nebraska-Omaha and an MBA from Creighton University and a PhD from the University of Nebraska-Lincoln. He's a former director of RS Investments and is the author of over 70 articles in scholarly journals and the co-author of several books, including Strategic Value Investing, The Tools and Techniques of Investment Planning. Dr. Johnson serves on the advisory board of the Journal of Portfolio Management. He has extensive media relations experience and has been quoted in the Wall Street Journal, Financial Times, Barron's, and Forbes, among others. He has appeared on ABC World News, Bloomberg TV, and CNN. He is a recipient of the Alfred C. Pete Morley Distinguished Service Award from the CFA Institute, the Robert F. Kennedy Memorial Student Award for Teaching Achievement, and Outstanding Faculty Member of the Year Award at Creighton for 3 years. Please help me in welcoming Dr. Robert Johnson.
And they're just the moderators, okay? And so I'm going to turn over to John McGinn, the opportunity to introduce the panelists today. Thank you, John.
Thank you very much, John. Thank you and welcome, everyone. I think we're indeed very privileged to have the panelists here with us today, and we're looking forward to we as the moderators asking them questions that have been prepared by the students and listening to their answers along with you. We'll do that for about 45 minutes, and then we'll open it to general questions from the audience as well. There'll be students going through the audience with mics at that time. In the brochures that are available to you, hopefully you picked up one when you came in. If not, please ask you to do so on your way out. There's a complete bio for each of the panelists. In the interest of time, I won't give you all of that detail. I'll let you read that at your leisure. But let me introduce the panelists, starting here on what would be your left. Patrick Brennan of Brennan Asset Management of San Francisco. Patrick's a CFA and has just founded this firm. This firm is just getting off the ground, but he's got many years of experience in the investment business, both in New York and out on the West Coast. Next to Patrick is Larry Cunningham, professor at George Washington University in Washington, D.C. Also has authored a couple of books on Warren Buffett and Berkshire Hathaway. We'll welcome him. Next to Larry is Tom Dignan. Tom is the managing director of North American equity strategist for UBS Global Asset Management, stationed in Chicago, Illinois. Next to him is Vitaly Katzenelson, Chief Investment Officer of the Investment Management Associates firm in Denver, Colorado. And finally, but not the least, is Sean Lynch, a global strategist for Wells Fargo Private Bank that's headquartered right here in Omaha, Nebraska. So welcome all of you, and we thank you for taking the time to be a part of this. And the students, thank you as well. Okay, let's start with the first question. Patrick, I'll start with you, if I might. As a value investor, is there a specific ratio or series of ratios or valuation techniques that you use and prefer?
I don't know if there's exactly one that I use. I try to use a combination of a couple, but I think a useful drill is if you sort of think about, ultimately the value of a company is, the sum of its discounted cash flows. So if you just go out, for the next 3 to 4 years and you sort of forecast what you think the free cash flow per share is going to be, I think what that exercise does is it sort of forces you to think about a lot of different factors that affect the business. What generally do you think the top line growth is going to be? Are margins rising or falling? Is capital expenditures a big item for a particular business? Are they a cash taxpayer, or maybe do they not pay any taxes at all? I think doing that exercise and focusing in on the free cash flow, I think that really starts and allows you to sort of give a pretty good feel for what that is going to turn, how much cash flow you're going to receive over a period of time. And then obviously from that you can start saying, well, I could place a terminal multiple on this, and if I discount this back at a certain rate, what multiple do how does that value compare with the current market capitalization of the stock? Or maybe you'd say that geez, this is a cable company, and I sort of have seen that they've been taken out at 7 or 8 times EBITDA, and I go out a couple years and this is sort of what I'm showing. What exactly valuation would that imply? And I think it also starts asking questions about if CapEx is rising a lot, or maybe if margins are falling quite a bit, that opens up the qualitative measures of the business. And how many, is there a lot of barriers to entry for this business? Is there a lot of new competitors, et cetera? And I think the important part of doing the exercise is not so much, okay, I get $8.52 versus the stock's trading at 6, and Argo, I know with certainty that that's my upside. We're trying to get directionally, in the ballpark. And obviously someone as smart as Warren Buffett, he can do it all in his head. For me, it's helpful to sort of go through the exercise in this format. And then, you layer in sort of, okay, if a recession happens, maybe what do these various numbers look like? And, maybe if it turns out a little better than anticipated, this is what it looks like. And it's sort of a range of values and it's a starting point, not the ending point. And I think I'd emphasize that. And I think and the second thing I'd really emphasize is the free cash flow, especially for something like a cable business. And I will talk about some John Malone entities later. I know that throws a lot of people off because they just say, well, it looks hugely expensive from a price earnings basis. But if you don't pay any taxes, you've got heavy depreciation, that maybe you don't have to replace that every year. I think that free cash flow per share can kind of point you in the right direction.
Would any of the other panelists want to add anything to that? Okay.
I'd just say I agree, and there's an old Charlie Munger joke about to a man with a hammer, every problem looks like a nail, and he's making the point that you've got to choose the right tool for the job. And as Patrick is saying, different companies and different industries will require different tools for evaluation. So having standardized, generalized benchmarks might be a mistake. It's better to do the kind of granular analysis with different tools for different jobs, different tools for different industries and companies.
First of all, it's great to be back at Creighton. I just want to make that clear. I do have mixed emotions, though, when Tony says that their rankings went up over the last year, because I left last year. So I want the students to know that there's a difference between correlation and causality. Okay? Larry, other than having the ticker symbol BRK, what are the characteristics of the ideal value company to hold for 20 years?
Oh, that's a good one. Well, I guess dipping into that BRK bag of knowledge, the first thing to look for is a moat, some sustainable competitive advantage that will enable you, the company, to resist competitive onslaughts, and whether from competitors or directly or from technological change and that sort of thing. And so franchise characteristics and a long-term record of sustained good returns on capital, I think, are very important. And then, of course, dipping further into the historical legacy, insisting on a margin of safety, being sure that you have a high degree of confidence in your valuation, and that there's a significant gap between the price that you're paying and the value that you're getting. And finally, what might be a good investment for Patrick might not be for me, because we have different circles of competence. I know very little about the cable industry, and I'd be very cautious about getting into it. And so there may be value opportunities in that sector, but I wouldn't be able to be confident about that. So, these are very fundamental propositions: the moat, the margin of safety, and the circle of competence. But those are, I think, the core basic propositions I'd begin with.
Would anybody like to add anything?
I'd add, and I think it would be worth reading after you read the Buffett letter. So Warren and Charlie each wrote their own letter this year, and I think they really hit kind of the 50 years and what drives their investment process. But if you wanted another example of a company that's planning out for 20, 30 years, read Jeff Bezos' letter from Amazon, which people don't think of as a value company, and on a multiple at the current earnings, it doesn't look like a value company. But if you want to look at a company creating a moat and widening that moat and investing for the long term, they're definitely in that category.
Let me just do a sound check for a minute. Is everybody able to hear the panelists? We have them. No. Could you pull the mics just a little bit closer to you, each one of you? Patrick, could you?
We'll have to share. I don't think.
Thank you.
And I think what Tom was talking about, Amazon, not the space shuttle business, right? Not the space business.
That's
drones,
correct.
just-
Yeah.
Tom, the next question is for you, and it's actually got two parts to it. First, what measures of risk have you found most useful for a value portfolio? And then secondly, what measures of risk have you found for individual value equities?
Sure. In terms of the levels of risk you're looking at, for the overall portfolio perspective, a lot of people, when they look at risk, they'll look at beta. And I don't think beta is always a really good level of risk. Lawrence made reference to margin of safety. And that's harder to do at the portfolio level, but I think you definitely want to look at that at the company level. And I think within the portfolio level, it really depends on your perspective. So, I manage a U.S. equity portfolio, and people do look at that risk relative to the S&P 500 or the Russell 1000. If you're looking at a more holistic global portfolio, then I think you have to look at it really relative from a more absolute perspective in terms of for the individual investor.
And you want to talk about risk characteristics of individual value equities, things that you look for?
Sure. On the risk characteristics at the individual equities, one of the things which you'll read in every disclosure is past performance is not indicative of future performance, and that's true. Past risk is a pretty good predictor of future risk. So volatility of an underlying stock is pretty easy to measure, and it's priced. The option market will tell you what the implied volatility of a stock is. So at the individual level, you can look at that level of risk. But then digging into the company, I think the balance sheet is something you have to be intimate with. You have to understand the leverage of that business relative to their competitors. If their ROE is higher, are they getting it from a financial leverage position? Are they just dialing this thing up? Because those are companies that obviously are going to be more subject to a downfall come a recession.
Yeah, I just wanted to add too, I'd reiterate what Tom said. Risk is so much more than just volatility. I mean,
ultimately, it's about losing money, and that brings into account your time horizon and your portfolio and how that's constructed. And I think taking a broader view of risk than just how volatile this asset may work over the past week or month or quarter.
Actually, let me add to this. If your time horizon is short, then volatility becomes your risk, right? If you need to pay for your daughter's wedding next year, then you can't afford volatility because suddenly you're going to have 20% less money. So volatility becomes your risk. However, if you're a stock investor, by definition, your time horizon should be more than 2 years. And if you're a stock investor, therefore volatility becomes not a risk, but a lot of times an opportunity, because and your risk really is a permanent loss of capital. I'm not saying anything new. Everybody on this panel would agree, I'm sure. So, to me, when we look at this modern portfolio theory inputs like beta, etc., to me they're just quantitative garbage. And the reason for that, because just in one of my books I talked about, I think I looked at the beta of Budweiser, and the beta went from, 0.9 to 0.6 over a 2-year period. The company hasn't changed, but the beta declined because I forget, the market went up or went down, and suddenly the beta has changed. So, but the company's, balance sheet hasn't changed, cash flows haven't changed, none of those things change. So, if your time horizon is short, very short-term, volatility becomes your risk. If you're a long-term investor, then really all that matters is a permanent loss of capital. And a lot of times volatility becomes your very good friend.
And can I add one more thing on the volatility? In the world, there's very few free lunches. The one free lunch in investing is, we do live in a semi-efficient market, so higher risk generates higher return, but you have higher risk. But to the extent you can add a riskier security or a riskier asset class to your current portfolio, and it has a low covariance or correlation with your current holdings, that's a free lunch. And you can reduce the underlying risk of your portfolio by adding risky assets to your portfolio that might be riskier what you currently own, so it'll increase your expected return. And that's where, from the individual investor perspective, or even like from my perspective, putting together a portfolio, how the stocks that you're looking at or considering for inclusion in your portfolio, how they're correlated with what you currently own is really important.
Vitaly, one of the things when I taught the portfolio practicum course, the most difficult thing for the students was to develop a sell discipline. What criteria do you utilize to consider the sale of an investment?
So there are 3 reasons why a rational person would sell a stock. Can you guys hear me well? I don't know if I should speak up or whatever. So there are 3 reasons why you would sell a stock. Reason number 1, it reached your fair value valuation. So that's a good reason, usually because you made money. The second reason is that because when you bought a company, you had a certain expectations of what the business is going to do, and those expectations were not met. So basically, the company disappointed you. So that's a more difficult reason to sell, but that's a lot of times that's the right reason to sell. And the third reason is when you see a better opportunity to buy something else. It's almost like when Warren Buffett was selling Johnson & Johnson in 2008, not because anything changes about the company, but there were so many other opportunities where he could buy cheaper dollars. Dower, instead of buying Dower for 80 cents, now he could buy Dower for 50 cents. So he sold an 80-cent Dower and bought a 50-cent Dower. So those are kind of 3 reasons why somebody would sell a stock.
How about anybody else who want to add anything to that?
Well, the only thing I would add, hopefully you can hear me a little better, is it depends on the value investor, but at the individual level, a lot of investments kind of fall into 2 camps of either a reversion to the mean thesis of some sort or another, or a compounder. And I think the compounders are the ones that you want to be a little slower on selling. And it just is, obviously being in Omaha, folks have seen the power of when you have free, low-cost, free, or sometimes even better than free float invested with a management team you trust who can allocate capital. The power of that model is amazing. And so I would say Markel is something along the compounder line. And if you had a strict discipline to sort of say every time it's above 1.5, 1.6, 1.7 times book, you're going to sell it. I think you could be making a mistake when you start looking at, potentially, what compounded free float over a long period of time generates. And it's tough to come up with those over time. But there's not a lot of stocks, I sort of would say, at a certain price I'd sell, and, that has to be the discipline with Markel as well. But, if they're in that compounder category, I think from the standpoint, too, of a lot of people are investing in equities in taxable accounts. And if you happen to live in the People's Republic of California, then, when you start selling a security and, you're going to pay out 50% in capital gains, I think you want to be tax sensitive. And so this is one area where I'm pretty sensitive to. If I think it's a compounder, I'm probably willing to hold on to that longer than I would for sort of a reversion to the mean thesis.
Okay, Sean, you're up next here, and I think this is a good one for you. And I'd ask you to just pull your mic a little closer. Okay. Sean, I think there's a little bit of trouble even hearing my voice in here. As a value investor, does your perspective or your analytical tools and techniques differ across global markets?
Yeah, a little bit. I think free cash flow and earnings should drive stock prices in any part of the world. But when we look at things, and in my global travels, one of the things that changes is visiting management. And in the U.S., that changed probably 15, 20 years ago with Reg FD, and you kind of get a watered-down version in meeting with management. And when you go overseas today, and all active managers we talk to, whether they're in India or China especially, it's a critical component that they meet with management. And as they go lower down the food chain of market cap, it even becomes more important. And again, whether it's how business is done, whether it's worried about corruption, et cetera, I think that's one of the things you see when you visit with managers in other countries is the importance of meeting with companies. It's kind of been a lost art a little bit in the U.S. I don't think it's done as much. So that would, I guess, be one concept from value investing. And then I'd say the other interesting thing, I guess, from an investor standpoint is it's still fairly new of the concept of diversification and longer-term time horizons from investors' perspective. In parts of the emerging world, and you see it in China today with the number of new accounts being opened, their time horizon's very short. It's very compressed. They want quick, returns, and the concept of a well-diversified portfolio really hasn't caught fire there yet. And I think that's something that may change. It may change as interest rates go lower, because if you've got 9% CDs and you're sitting in India, you're going to demand a lot more out of equities if you jump into the equity market. As rates go lower, they may say, okay, maybe a balanced portfolio comes into play here. So, John, I'd say, again, one thing is just visiting management, and two, that concept of a diversified portfolio for investors may see broader use overseas in the coming years.
Okay.
Back to Patrick, and I'm very interested in the answer to this question because the first share of stock I ever bought with Berkshire. So can
Lucky
Berkshire
you.
continue to be a good investment over the next 40 years?
Betting against them in any shape or form strikes me as not the best of strategies. So I think they'll do fairly well. I think. Certainly if you read the letters, the size, one of the benefits of, the growth of the float will be more challenging over time at this size. So I think that's, potentially a headwind. And I think what a lot of folks wonder about is when the next crisis comes around, whenever it is, the sort of, private lender of last resort, is Berkshire going to still receive those phone calls, and are they going to be able to pounce on the opportunities? And that's a little bit of a to be determined, I'd say. But I don't know if people here would if Burlington Northern is, there's, if the rail car shipments 10, 15 years from now, I think are still going to be slugging along. They have several other businesses that will continue to consume a lot of capital, and that should take some of the pressure off the newer management team. But it's completely unrealistic to expect the same results that have happened in the past. But if you have that one chair and, hopefully your cost basis was somewhere from, in the 1970s, then, I'd still be reluctant, to sell that. I don't think you'll do as well, but I think they can probably do a little bit better than maybe some of the more negative people think.
Here's a Charlie Munger imitation. Yes. And I've just written a whole book about that in a way. In Berkshire Beyond Buffett, The Enduring Value of Values, I take stock of the entire corporate entity as it stands today, where all those pieces came from, and what it all amounts to, and anticipate what it's going to look like. And the remarkable thing about this company is that 20 years ago, I might have been concerned if for a Berkshire without Warren Buffett, because back then, 80% of the assets in the company were in minority positions, common stocks that Warren had picked, and most of the value in the company was in his investment savvy. 20 years later, it's the other way around. 80% of the assets in Berkshire are in wholly owned businesses. So the company is now not a mere investment vehicle, but a very well-managed business organization. And I discern 9 distinct values in Berkshire's management style that are unique in corporate America and that give it an enormous competitive advantage, starting with financing, the float to which Patrick referred to, but also deferred taxes, retained earnings, earnings from what Buffett calls a gusher of different enterprises with significant cash flows, a commitment to permanence. Berkshire hasn't sold a subsidiary in 40 years. It will continue to attract opportunities to buy businesses on the strength of that commitment alone. It gives its managers unbridled autonomy, unseen in any other business organization. And people prize that, whether it's families trying to run a business or entrepreneurs trying to cope with short-term hiccups in the business cycle. They have a deep commitment to entrepreneurship, to investment savvy among the managers, to allocating capital successfully. And there's been no other business organization in history that's all like this. So they have institutionalized these qualities and traits across the organization. And so unless some idiot or group of idiots somehow manage to get control of that operation, this business is going to continue to prosper. For 40 years, that's a big number. And the only thing that makes me sad about that, Vitali's point, is I'm going to have a daughter's wedding to throw between now and then. And I might have to shed a share or two. But otherwise, I'm bullish on Berkshire.
Tell her to hello.
Here's a value investor. My wife and I did, incidentally.
Oh, so you're smart.
Our next question from the students is, how do you determine your cash position in an overvalued market?
I think that's a great question. So it's, how do you determine your cash position in an overvalued market? So I run a U.S. equity fund. We're 100% invested all the time. So and the reason for that is the people investing in our fund are doing their own asset allocation. But I think for investors, and I think 2008, 2009 is an example, it is nice to have some dry powder when things get really cheap. But I think one of the greatest challenges is the people I knew with dry powder in 2008 and 2009, a lot of them still have it. Because they're always going to buy in the correction, right? Market went up, going up. They kept waiting for this 10% correction. And I think as an investor, you have to you really do have to focus on the long term, and that's hard to do. And over the long term, cash is a really expensive thing to hold. But, and this is where it gets to each individual's needs and short-term demands for liquidity, yeah, I think you have to be careful about carrying too much cash. It's in our business, we want to be providers of liquidity, but I think, from my perspective, oftentimes the best source of my liquidity is maybe a current holding I have. You know, as Vitali said, when you hold something that sometimes you're selling because there's a new and better opportunity, but I think people, if anything, tend to hold too much cash.
Let me try to answer this question. Tom and I have a slightly different perspectives because Tom, usually probably you're just one of the buckets, you are.
I'm just a bucket.
Yeah.
But also, I would add, the bucket I've managed, this asset class, there was a period about 5 years ago when everything was cheap. Now, modeling DCF, you kind of assume things are going concerns, and there was question whether or not all entities were going concerns. I've only been doing this 30 years. I still haven't hit the environment where everything is expensive. During the tech bubble, everything was not expensive. You had pockets. Now, we could hit that. So I don't want to say that won't happen in the future.
Sure.
But
So our view is slightly different because a lot of times clients come to us and give us all their money. So it's a very different view. It's a very different view. So in our case, cash is a byproduct of our ability or inability to find stocks to buy. And to contrast, Tom, our new accounts today have about 70% cash. Our existing accounts have about 30% cash. And this is not me trying to time the market. And I would argue that, I would agree that I think timing the market is not something you should do because it's very difficult to put it into process. It's not something you can, if you've done it once, that's the worst thing that could happen to you because it's almost like going to Vegas and winning because you think you got it figured out and you don't. Next time you won't be able to do it. So you really want to, the way we do this is basically we look one stock at a time. If you can assemble a portfolio of stocks, then we're going to be 100% invested. If we can't, cash is going to be a byproduct of that. So I would argue in today's environment, cash is better than overvalued stock. Again, when I'm responsible for somebody's future, to me, is a more responsible way of doing it. So that's my answer, I guess.
The next question from the students is one I'm also particularly interested in. I have a book up on the table up there. This is a shameless plug called Invest with the Fed. And the students ask the question, does Federal Reserve interest rate policy affect your value investment decisions? And if so, how?
Oh, this is great. I got a story to tell you. So yesterday we went to a restaurant, and it's called Ahmed. And this is like the first time I've been to this restaurant, and it's kind of Middle Eastern restaurant, so I'm not sure about the food, etc. So we're eating the food, and a friend of mine asks me, so what do you think about the food? And I said, it's great, but you don't want to judge it right now. You want to wait 2 hours. Okay? So just think about this for a second, because if you judge Fed's policy today, yeah, it tastes good so far, right? But it's really how you're going to feel after that. That's what really matters. So I think we live in this, as an investor today, you can't really look back and say, when this happened in the past, this is how it worked out, okay? Charlie Munger has this saying is that if you're not confused about the economy, you don't understand it. And this is how I feel as a value investor because I'm extremely confused. And so what you try to do, and this is why, this is in part explains why we have so much cash, is you try to create this portfolio for this future world, I don't know world. You don't know how things are going to work out. You're going to have these two camps. You have inflationist and deflationist. And I wrote this article, and there was a one line saying there is a risk of inflation, and I got an angry email saying you don't get it, we're gonna have deflation, and then there was another line there saying in the article was there was a risk of deflation, and I got another article, another comment from a reader saying you don't get it, we're not gonna have deflation, we're gonna have inflation, vice versa. My point is this: we really have no idea how this is gonna work out, and the way you want to structure portfolio is basically saying, if you're going to have inflation, this company will do fine. If you have deflation, this company will do fine. And you want to err on the side of, I may not make as much money if one scenario works out, but I'm still going to be okay if either one of them comes, hits me. So,
I just add, as global strategist and head of equities, it's just had tremendous pull short term on the markets, and I've surprised at the volatility that's injected removing the word patience, and I'm getting calls and interviews to set up what does this mean for the market, and to me, as an old value guy, you want to focus back on the fundamentals, but clearly the markets are watching the Fed, and it's not just the U.S. You look at emerging markets and summer and a half ago or a year and a half ago, just removing the word taper from their statement caused emerging markets to fall 17, 18% in a month and a half. And so I think Fed watching is important. It's important to the markets. Hopefully, longer term we go back to fundamentals, but I think it'll be an interesting fall if and when the Fed does decide to raise rates, what we see happen in the emerging markets and what we see happen in the U.S.
Thank you all. Sean, let me ask you this question. Warren Buffett is well known for his capital allocation skills. As a value portfolio manager, how do you determine asset allocation by sector and by company?
Well, I take a broad view. So we have a 4 asset class view at Wells Fargo, and I'll talk a little bit about equities, and then we have tactical views within the markets. And we take a look at valuation, we take a look at, again, our capital market assumptions, and do we think in the next 9 to 12 months from a tactical standpoint, one group will outperform. If you look at it today, we're tactically overweight large cap U.S. stocks, we're tactically overweight international and developed stocks. We're underweight the bonds of those asset classes. So we're underweight U.S. bonds and international and developed bonds. So for us, it's more looking at it at a portfolio context, where we think the value lies, where we think, again, the opportunities lie in those big asset groups. Now, we do drill that down into sectors, so we do make sector calls within the U.S. We're a big believer that we like some of the cyclicals in the U.S. We like the industrials area, we like technology, and we like consumer discretionary. We're not as big of fans on energy. We're neutral there, and we're underweight the staples and utilities. One of the reasons why is we want to be in some of the companies that are going to be beneficiaries of lower energy and not necessarily the energy companies themselves. That's one reason why we like the consumer discretion. So I think it's important to have those views at the high level, and I think you can add value through your tactical calls, and at least in today's market, that's where we'd want to be positioned.
Can I add something? So Warren Buffett, so this is kind of interesting. In 2007, value investors were basically saying, Warren Buffett doesn't care about economic forecasting, so I don't care about this either, so I don't do macro. After 2008 crisis, now every value investor I know is a kind of expert on macro stuff, and and basically starts looking at all this garbage they put out every day by the government. So in my mind, value. If you look at Warren Buffett, he basically said, I don't really care what the Federal Reserve is going to do the next 6 months. This is the cue that value investors took and said, we don't care about macro forecasting. But if you look at what Warren Buffett was doing over the last many, many years, he looked at not what the weather is going to be tomorrow, what the Fed is going to do tomorrow. He looked at this big climate changing events. He looked at, he said that the stock market was overvalued in late 90s. He said the Dow is going to decline. So that's a macro, by the way, that's a macro forecasting, okay? But he was just not focusing on things that are very volatile and have very little consequence in the long run, and he was paying attention to climate changing events. Also, the problem is when you're a weatherman in the stock market, you basically spend a lot of energy for something that has a very short-term shelf life. Therefore, as an investor, you want to identify risks, big risks, or or positive events that lie lie ahead of you and focus on them. So that's.
Yeah, I think we've written some articles about that as does macro matter, and certainly in the short term it seems to be impacting the markets. Longer term you want to go back to the fundamentals, but it's getting all the attention lately by investors, and it's frustrating. It's frustrating to see the volatility in some assets get hit when you have a bad GDP report out of China or a PMI number that comes out and it's sending the markets down 150 points.
Earlier, the concept of circle of competence was brought up. I believe you brought it up, Larry. Patrick, how did you develop what your circle of competence is? How do you identify that? How do you develop your circle of competence?
Some of it is ad hoc, and some of it's just what your background is. You know, I had a previous background in, you know, I long ago did, you know, M&A in financial services. And financial services, for most generalist value investors, are just, they're you know, they're weird. And they're hard, and people sort of stay away from them. So and a lot of people sort of say, well, you know, leveraged commodity businesses, yuck. And so, you know, so it's, in certain cases, that might be true. But I think that is sort of where an opportunity is. You know, the one I still get over, you know, most, if you look back, it's pretty close right now between, you know, if you could have given your money to, you know, the Oracle of Omaha versus a certain cable cowboy from the Colorado area in, you know, in the 70s, it's real close. And the compounding of, you know, Dr. Malone is incredible. And I feel like more recently, especially maybe with the publication of the Outsiders book, he has gotten some more attention. But you know, it's amazing for me. If to a circle of competence, if you do one John Malone investment, I kind of think it just opens your eyes to just it's a walking special situation, but it's a lot of work for that initial one investment. And so I've been investing in those in, you know, sort of for 12 or 13 years. And so when one part of the empire, and I count something like 30 different companies, either that are direct Liberty companies or they're, you know, invested in by John Malone, you know, it's a huge pool of alpha potentially. And when one of them fell recently, Discovery Communications has become quite a hated stock after sort of being the darling of, you know, the content space for a period of time. And it's a function still of, you know, you have a sort of weird voting ownership structure. You know, you have concerns on, you know, sort of on a macro level, their international exposure, et cetera, and then, you know, the changing within the cable telecom space. But, you know, so how is that in the circle of competence? Well, if you've, you know, bought QVC in the past, if you've owned Liberty Media in the past, it's sort of easier to quickly pinpoint and say that, you know, complexity is often used to avoid paying cash taxes, and it's just a temporary phenomenon. And so I think doing that, it opened up sort of a little bit of circle of competence, you know, within media, telecom, but also just, you know, with Malone-specific entities. And, you know, I think that I would encourage, you know, folks to, you know, to take a look at, you know, if you're going to invest in the time and sort of something for very mainstream, some of them with, you know, large cap stocks that are completely misunderstood. I think that's a great bucket to dive right into.
Larry?
Yeah, I get this question from my own students all the time. It's a broader question than just what's your circle of competence in investing, but it's what are you interested in life? What are you good at? What is your skill set? Because that's ultimately what the circle of competence is. It's the capacity to evaluate a business with a high degree of confidence so that you can make a capital commitment to it. And it's very hard to figure that out, especially when you're 22 years old or 25 years old, because it takes experience. And Warren Buffett didn't know his circle of competence when he was 25 or 30, and he made a lot of mistakes for a decade, thinking he knew about department stores when he didn't, thinking he knew about chocolate candies when he didn't. So it took him a long time. So don't be concerned and don't rush it. I always say it's much more important to have very thick boundaries than to have a very big circle. So, you know, you just focus in the beginning on things you know, things you've experienced. That's how Warren started. Products that he likes. I mean, look at his early portfolio. It was consumer staples and things like that, things you use every day, things you know about, and that are interesting to you so that you are happy to stay abreast of it, to learn about it, to read about it, to think about it, to make adjustments as you go along. So it's a process more than a moment, but it's just very important to be aware of it and to be aware of those boundaries and to stay within it. So it's as much of a discipline and an attitude and a philosophy as a concrete proposition that, you know, I know about consumer staples, but not about cable. But so just develop that sort of self-reflection, that self-awareness. That'll I think, steer you quite well.
And I would add just real quickly, if you can identify your blind spot, surround yourself by people that are really good at your blind spot. You can't always make up for it. If you're weak in accounting or you don't understand a certain technology, get people around you that do and trust them.
I would add 2 points to add to to what Larry said, especially. First of all, you learn by doing. I think that's about that's everyone is going to have a different circle of competence. But I think there's a second point which is as important. So you want to separate IQ and EQ. So emotional intelligence, how well can you analyze a company? And then the second question is, can you be rational while you're holding this company? So every one of us has limitations on the rationality. So let me give you an example. I have a friend who will never own, he said, I will never own grocery stocks. And maybe, I don't know why, maybe he got caught stealing a candy bar when he was 8. So that's why he knows when he's going to hold if something goes wrong while he's holding this company, he's not going to be rational. Personally, I am not a very good investor in gold stocks. I know I will not be rational. If gold prices go down to $800, I will be selling, even though I should be willing to buy more in theory. So what you want to identify, what you understand, which is IQ, but more importantly, what is your EQ? Are you going to be rational? Because realize this, IQ is not constant. Okay, IQ will change with your EQ. So if you become emotional, your IQ declines. So you want to make sure that both company meets both EQ and IQ.
So I've got to add something. I would just say that one of the things that I've run into with some of the analysts when they see their circle of competence is it's great. They're sharp, they know their stuff, but they can't pull the trigger. And at the end of their analysis, it's would you buy this stock, and they can't make that decision. So I think as you go throughout your careers, that's the one thing you need to develop is that confidence once you get that circle of competence to make that decision. And again, I think when I talked to the students a few weeks back, the one thing that I just recommended is as you develop the circle of competence in other areas, the key is knowing how to value an asset, know how to value a company, and know how to do it pretty quick. And that's a skill that you try to develop as you go through your studies.
Very good. I think this is a good place to stop, and we'll throw it open to the audience. I would ask you if you have a question, and we would invite those questions, if you would just raise your hand, and we'll have students up here with microphones. There's a question right here in the middle. Are there students with mics? Okay. There we go. Gentleman in the, would you raise your hand again, sir? Oh, he's got it up. Pardon me. Can you see it up there? Up. We'll get to you. Okay.
Yes, my question is a very simple question that I would like all 5 panelists to answer, starting with Vitaly. Okay. IBM, yes or no? at today's prices.
Maybe yes. That's it. That's the answer. So.
No.
No.
We're both trying to be Charlie Munger.
Yeah, we're both trying to be Munger. Although, are we allowed to say more? Or? Sure. I mean, the other two have to answer those. You know, I wouldn't buy it for myself. I'm
Larry?
very happy to be
you
a Berkshire stockholder that owns IBM stock. As a partner in that enterprise, I feel like I own a piece of it. So I'm very happy with that decision having been made, and I wouldn't recommend selling it right now. I'd be happy to hold it. I think it's got enormous potential in AI especially. So I'm neutral, I suppose, in the end.
I'll give you a slightly more, I think, which I took a hard look at that in 2013. I think a problem that with IBM was those 5-year plans. You know, they had like one too many of those. I mean, they were cutting bone a little bit, and they hit the last one via cost cutting, essentially. And so, you know, there is clearly at some point the cloud computing is a big enough portion of the revenue, and once you hit that point, it could be fairly interesting. But you know, they took on a lot of debt to buy back the shares, and I think that they got to a point where they were trying to manage earnings to hit the second 5-year plan. And the idea, the concept was great. I wish Microsoft had a 5-year plan to have a little bit more capital discipline. But I think that the second plan was a bit too much, and I think It's harder to come up with a lot of downside, but I would not purchase it right now just because I have trouble getting significant upside from this level.
I knew there was a reason I should have talked to compliance before the call, but yes, we do. We own it in our value model.
Okay, next question now, the gentleman up here. Thank you.
Hear me? Yes. Okay, okay. There's an industry that historically has been a horrible industry, but recently has done very, very well, and that's the airline industry. Now, our investment club at the college I teach at just about a week ago bought stock in a company called Spirit Airlines. Now, just the other day, Spirit Airlines stock dropped 11% because they said that their forecasting for the next quarter, revenue per available seat mile is going to be down 14 to 15% versus the same quarter a year ago. My concern, we're still holding the stock, and I have it in my own personal portfolio as well. My concern is the airline industry starting to turn back to the industry they used to be, with too much competition, too low fares, too many empty seats? What do you guys think?
Tom, go ahead.
Yes. There's no barrier to entry. Longer term, I don't think there's been any structural change. There's been a cyclical change. It's been a great place the last couple of years. But if we're talking about a 40-year company, I wouldn't pick Spirit. And if you're going to fly Spirit, bring extra cash in your pocket if you want to, have oxygen or water or anything on that flight.
That's a good one.
Sounds like a short.
Any other comments on the airline industry? That was great,
No.
Tom. Yes, also up in the middle. Oh, I'm sorry. Yeah.
Is this on? Okay. My name is Nojin Chu. I'm from San Francisco. I've actually, this is a quick question for Professor Cunningham. I emailed you about getting some early Berkshire 10Ks, and just a brief question, and I'm going to segue into my actual question, is that, so I spent like hundreds of dollars finding these like old 10Ks, and I found them, and my question to you is like, why have there not been more, I guess, books and analysis on the shareholder letters in conjunction with the 10Ks, which is what I'm doing right now. And I mean, maybe I've answered my own question because it was $500 to pull all that stuff from DC and all these places. But that's just a general question I had, because I want one thing I picked up from the 1967 10K, for example, is that Buffett immediately changed the depreciation schedule, and he accelerated the depreciation on his fixed assets. And to me, that was huge, and that's not talked about in the shareholder letter. And what that is deferred tax liabilities. So, and that's the float that's generated from Burlington Northern, and he did that in 1965. So my question is, why hasn't there been, I guess, a deeper analysis of the 10Ks?
Well, it's nice to see you, and
Yeah.
thanks for that email, and I'm so glad you went and dug those out. I don't know why others haven't rooted through those archives. For me, I found Warren Buffett's shareholders letter so delightful and accessible and contemplative that when I began to become acquainted with them in the early 1990s, I thought, boy, this is a treasure trove of knowledge and information and wisdom. And so that's what inspired me to organize a conference featuring them and to arrange them thematically in the essays of Warren Buffett. And so I found those to be just lyrical and profound in a way that the 10K itself seemed more technical, lawyerly, and so on. So that was my own experience. I applaud and admire your archival excavation, because I think it will help us as we collectively transition from thinking about Warren Buffett, as a personality and a leader, and into Berkshire as an institution and a corporation. I think there's probably going to be a lot of great knowledge that you'll be able to uncover. And
that leads, sorry, my actual real question is that and this is for the entire panel, is that So I left the hedge fund industry, and I've been studying the insurance business for the last 3 years, and we're launching a fund to acquire this summer to acquire a carrier and other float-generating businesses. And when looking at Berkshire, I mean, half the shareholder letters are about insurance, yet I guess like when you look at the Wall Street Journal, it's everybody's focused on like what the stock picks are and whatever. And this is just my personal opinion, but I feel like if you are going to have a deep value program at a school like Creighton, like you should also have a deep liability funding program. And what I mean by that is that, like when you buy a house, people say, "Oh, okay, I sold it for like double the money," but no one ever asks like, what were the terms of your mortgage? What was the financing? Where did the capital come from? And what are the terms of that capital? And to me, and that's one of the reasons why I left the hedge fund business, because, I mean, my girlfriend broke up with me because I left the hedge fund pay, but the point was that I realized that the funding mechanism is, so for example, like if you own a lottery, that is a source of float, and that is, and if you, in the States you can't do it, but internationally, one of the things we're looking at is acquiring a lottery company, and that is a different form of float that's comparable to insurance. But like, why is it that most people, including the Wall Street Journal, only they focus so much on the asset investing side when the entire picture for Berkshire is the funding side as well?
Let's go. Let the panel go ahead and answer that.
Maybe Patrick, you have a.
Yeah, I'm trying to think which part. There's one part of your question I won't delve into more. I would say that one of the problems is, I think what you're getting at is that, and it's been alluded to in the letters as well, is that the liability for an insurance is not as hard a number. And the concept of it as, a revolving door, if money's coming in, money's going out, it's not a static number. And so that means a lot of times the liability is probably vastly overstated. And so that's the beauty of insurance. And so there's a lot of hedge funds that sort of see this as well. And, really an insurance company with invested in equities can really be a leveraged play on equity. It can be a low cost, leveraged equity investment vehicle. I guess what I would argue though is that over time, you're going to get a higher multiple and you have a higher franchise if you underwrite well rather than on the investing side. And so that liability that I think you're going in the right place. And I think in the most basic statement, if you had a choice, you would rather be a A underwriter and a B investor than the other way around. And to me, that's why Markel is along. I mean, for a period of time, that at their size, their underwriting history over a long period of time, I think that's going to generate more franchise value than something like Greenlight Capital, which arguably you could say has a more talented investor on the asset side. But the price to book multiple, I would predict for the next 10 years, would be significantly higher on the Markel side, and probably for good reason.
That was profoundly wise and accurate. And I just note that another titan in the insurance industry follows precisely that model. That's what Hank Greenberg had always said at AIG, that he stressed underwriting discipline and an underwriting profit as the number one thing. And investment was quite secondary. And it is sort of interesting that Warren is the other way around. I mean, underwriting discipline is vital, he says, but he makes the most out of the float. So it's an interesting comparison.
People the idea, if you underwrite at a profit, that's better than free money. And you think about that for it took me 10 years to sort of, to really get comfortable with that concept. And that's probably more important for an insurer than what the underlying price to book is at a given time.
And just one more note, as if private equity and hedge funds find the insurance business attractive because they think it's going to be free money, they should be extremely careful, because insurance is a very risky business, a very dangerous thing, and it's very tempting to generate premium volume rather than focus on underwriting discipline. And that's why so many insurers open and close. Why Berkshire and AIG are sort of exceptional.
Okay, our next question. Yes, up here at the top, middle.
When you value investors, look at Japan now. What kinds of things do you see there?
I think the key thing is are we seeing movement in the economy? Are we seeing a little bit of reflation, which is what they're trying to do there? And I think you are. Recently, we've seen the equity markets move ahead without weakness in the yen. Traditionally, what we've seen the past couple of years is their markets move, but we see the weakness in the yen as a key driver to that. And I think you're starting to see the equity markets respond and do well on their own. I think the other interesting thing about Japan is the whole focus around corporate governance and return on capital. You see now that their government pension fund is investing in equities. There's new indices that are being set up by the government that will screen companies on return on equity, which has historically been pretty low in Japan. So I do think that things are a little bit different in Japan here. It is one of the reasons why we still are overweight international developed markets, is the fact that they do seem committed to a little bit of reflation here, and you're starting to see that in the country, which is a good sign. And I would say, again, from an export standpoint, they're starting to see the benefits of that weak currency versus some of the other exporters in their neighborhood.
Question right here? Or do we have one? Okay, pardon me, sorry.
Somebody mentioned they wished Microsoft had a 5-year capital plan. I think it was Patrick, and I happened to be at the annual meeting last year, and I asked the question, when would, like, the stock was at record highs and the CFO was bragging because, I don't know if we can talk about companies like this, but was bragging about the fact that they'd bought back more shares than ever. And so I got up and asked the question, at what price wouldn't they buy back shares anymore? And it's on the transcript. I don't think they actually got the question. They both talked about how wonderful the future of the company was and how the great ideas would lead to various things. And I was very tempted to just walk out and sell everything, because the valuation was now twice as high, and the stock, the earnings had actually just stayed flat. So, and you know, question is what it'll do the next 5 years. But maybe you want to weigh in on would you buy, like what is your views on the valuation, and maybe more on that capital plan idea, like what are they doing wrong?
Yeah, well, so when the first question was asking about IBM, at the same time, when we were speaking to IBM and sort of forming a view that they had done, you know, as I said, one too many 5-year plans, we were trying to get the director of investor relations for IBM, do you know anybody over at Microsoft? Is there, you know, any way you could kind of talk to them about the 5-year plan and see if something would rub off on them? And I have been selling Microsoft shares at this price. I think that, you know, the stock has moved from sort of 27 to the high 40s. Here I come out, you know, in the $55-ish range. I think for the case of Microsoft, really one of the needle movers is actually kind of global tax policy. It's sort of this cash that's overseas. You know, what's going to happen is, you know, where a big boost for Microsoft would be if they could somehow bring that cash back to the United States in a more tax efficient manner. That would be enormous, not only for Microsoft, for a lot of the tech companies, but, you know, some of the political rhetoric suggests maybe we're going to go in the opposite direction of that. And I always thought that, you know, one of the big problems is it just burns a hole in your pocket, and you can make like a financial case to go out and do a big acquisition of an overseas companies because you save on, you know, the tax burden. But, you know, a new administration at Microsoft, you know, you hope they get it a little bit better, and rather than, you know, buy some of the stuff that, you know, the Skype bidding war. I mean, it was just the epitome of Microsoft was, I thought, Steve Ballmer's bid for the LA Clippers. I mean, it was just, I mean, in a nutshell, that seems to be how he bid for everything at Microsoft. And so I think with a new team, they've done well, but I don't, you know, how much more upside is really, and you know, you're certain the circle of competence, it was a play, this huge cash position, it traded a very low multiple of free cash flow. It's a lot harder right now, I would say.
Actually, I have two comments about Microsoft and one comment about 5-year plan. So I think Microsoft problem is, under Steve Ballmer, it had a broken culture. And I think it just, basically that's what that was its biggest problem. Because I don't think a company with a good culture could come out with Windows 8, right? Yeah, with Windows 8. But let me talk about the 5-year plan. So I was born in Russia, so I was exposed to 5-year plans. And so the problem with 5-year plan, and this is, you can actually relate this to Chinese economy, to the problems in Chinese economy today, is that basically your earnings growth should be byproduct of a lot of economic decisions on the fundamental basis, basically your revenue growth, your margins, all these things, and basically capital allocation. When a company has a 5-year plan, and that plan, that goal is earnings, they'll hit it. The question is, what will be the price of that in the longer run? Okay, and Patrick, you made a great point. I think IBM is paying a price for that today. So I think, and this is what you're really asking. So I think capital allocation should be like when we analyze companies, we analyze management, and we analyze them in 2 different buckets: how well they run the business, but the second question is we look at their capital allocation decisions, and that's 2 different questions. And one, I would argue that you can lose so much money so much faster by management making horrible capital allocation decisions. Okay, because they can leverage the company, they can make better acquisitions, those kind of things. So, coming back to Microsoft, so I think you agree with you 100%. So the company should be buying stock when it's undervalued. Okay, and one thing I found over the years that management is not very objective, unless it's John Malone or some other great capital allocators, at valuing their own stock, because management start believing in their own. You know what I'm talking about. And I think therefore they fall in love with their company, and they usually pay very high prices for their stock. And if you look historically at the share buybacks for S&P 500, management, just like mutual fund investors, they buy high and sell low. Basically, they just buy high. They buy stocks today. They didn't buy it in 2008. So that's.
Let me ask the guys that run the fund, does the dividends in old tech attract you guys that are running the funds? They're 3% on a lot of those names. Is that something that comes to play at all?
Well, I would say you don't want to look at the dividend alone, and I think Microsoft's a perfect example. If you have a great company with a great franchise, and they're not allocating the capital, they're not either reinvesting properly or they're overpaying for things, it's not worth buying. Because the biggest difficulty is when do you sell that? Because if, what you talked, I think when you went through the sell discipline, one of the key points you had is, are they executing on the business? Like doing what we thought they could do. That's a company that could execute on the business and not succeed from a stock price perspective because they're flushing money away on very poor capital allocation. So I would never buy anything just for the dividend alone.
Actually, just one little point. If you think about it, the value of any company is the present value of its future cash flows. But there's an assumption those cash flows will kind of come back to shareholders. In case of Microsoft, they were just throwing it away, basically.
Berkshire Hathaway is not only a conglomerate, it owns conglomerates. It owns conglomerates that multiply by bolt-on and tuck-in acquisitions. It is growing and will continue to grow. It seems like, looking at it, it's sort of grown like Topsy with no design beforehand. It seems like opportunities came along without any thought that these opportunities would give us diversification. But is it possible, and I ask this panel to consider this question, that Berkshire Hathaway ended up being internally diversified, which means that if you held a major position of your portfolio in Berkshire Hathaway, that you would be to a great extent, diversified and protected on the downside, especially when, on the downside, if it gets down enough, would give Warren Buffett and his successors the opportunity to buy back its own shares as appropriate. At this point, it's 120% of book value. I'd like your thoughts on this matter.
Yeah, the first sentence of Berkshire Beyond Buffett is, Berkshire Hathaway is an accident. It's never had a business plan. It doesn't believe in strategic plans. It is purely opportunistic. And Warren's mindset, and Charlie's, coming back to an earlier question, is to have as broad a set of opportunities as fits in their circle of competence, and then just conduct opportunity cost comparisons and allocate capital to the best one, whether that's a chocolate confectioner, or a newspaper, or a maker of pumps, or that's Scott Fetzer in 1985, one of the first mini conglomerates that you referred to, and that's been the activity. It hasn't been planned out at all. And another one of the conglomerates within Berkshire is the Marmon Group, and it was grown organically along that same opportunistic model by Jay and Robert Pritzker over a period of 30 years, who's a great hero of Warren's. And so that's the model. It worked very well at the Marmon Group. It's worked very well at Berkshire Hathaway, and I think his successors will understand that philosophy and execute that playbook and continue to operate it. Warren has announced over the years a price point at which the Berkshire would find repurchases of its own stock an attractive capital allocation. So we sort of know what those parameters are, and those men and women who succeed him know what those parameters are. So I don't think there's any mystery about how Berkshire got to be what it is, and it's pretty clear what the playbook is for the future.
Your answer makes me glad I asked the question.
Thank you very much.
I know we have a question. Okay, pardon me. Here we are.
Oh, I got two questions, or do you want me to choose the more important question?
Choose the easier one. Yeah.
I'll go with the two questions. You guys talk about the DCF model and growth rates. However, what about companies that have negative growth rates? For example, Warren Buffett in the newspaper business, and another example, the coal business.
It requires a much greater margin of safety. That's the answer.
Okay. And my second question is, I'm trying to do research on if a small enterprising investor has an advantage over a large fund. With that being said, as large fund managers, what kind of restrictions do you have when owning and purchasing equities? Do you have a minimum share price, minimum market cap, 52-week low restrictions, high volatility stocks, market fluctuations, concentration of capital, for example, your best idea over your 10th best idea? Also, how long can you hold and possibly continue to invest if an equity is down 30, 40, or even 50% without investors starting to worry and pulling money?
I don't have this problem. I think Tom and
I have a lot of problems, but we don't have time for all of them. Those are all self-imposed restrictions. So different investors have different restrictions in terms of number of holdings, concentration, how low, if they have their own stop-loss mechanism. But I think that probably varies from manager to manager.
Yeah, with our couple $100 billion in assets, and at the Institute it's over $1 trillion. I mean, we have to have the liquidity to get into a name in our large funds. Otherwise, it's the Roach Motel. I mean, we get in, but we can't get out, and that's what we got to make sure we can, is to get out of a position pretty quickly when we decide to go.
The only thing I would add, I think what you're alluding to in the question is the individual investor, to take advantage of that, looking at the places that are very hard for large equities, the known sources of sort of outperformance, when you go into spin-offs, you go into, small bank demutualization, when those are coming public, tracking stocks, et cetera, those are, sort of pockets that's very easy for individual to go into, and there are just by size of, certain buyers they can't touch.
And one thing you asked, I didn't address, and this, I'd be curious how other people feel about this, but you mentioned, well, if you own a stock that's gone down significantly, do you feel like you have to get rid of that stock, because your clients will see it and it'll look bad? I've never, maybe I'm naive, I've never understood that at all. I mean, if I'm up 10%, the market's up 6%, that's really what my investors, my clients care about, not what did you hold at the end of the year when we happened to measure it, and what was it relative to what you bought it at? So that's something I'm not sensitive to, but I don't know. Like you read about that in the papers, but I don't know anybody that actually does that.
Next question.
Hi.
Okay.
Probably one of the biggest issues going on today is the massive quantitative easing going on throughout the world, pushing up the values of all these different asset classes. What do you think the consequences of that will be long term, and what asset class do you think is going to be the best to hide in from a value perspective?
Great. Well, I think those countries that are implementing QE are in easing mode. It's providing the risk is that they look at the U.S. and they say, okay, that was a nice bed of safety that was underneath the markets, and that's what's going to happen in Japan. That's what's going to happen with the ECB. And when they pull that all away, what actually does happen? So that's the risk side. We take a look at it, and you actually do see, green shoots in Europe. You start to see the economies improving. Germany's GDP was actually higher than the U.S.'s. Now, that's not saying much for the first quarter, but it was. Spain is actually printing positive PMI numbers. So maybe just that confidence level, not only what the Fed did, but what Mr. Draghi and the ECB are doing is injecting a little bit of confidence in Europe, and you're seeing it in the core European countries. Japan might be a tougher issue. Again, we talked about earlier. I mean, it's helping now, but they still have the demographic issues that go about. So when you talk about what asset classes to hide in or that might help, we don't see Armageddon coming in terms of when they start to remove the stimulus. We actually think it provides some nice, again, safety on the downside, and we think equities are a good asset choice in that environment.
I think we have time for about 2 more questions. Yes. Can we get a mic over here on this side? Thank you.
I know.
All right, first, thank you for speaking to us today. Secondly, my question is try to get your insights on Jamie Dimon's comment that the government has sort of gotten too far on regulation and that banks will be less able to respond to the next financial crisis. And related to that, whether you think that deregulation of some of the Dodd-Frank Act will make the industry a more attractive investment class going forward.
I can't answer that one. I've got, with my, I'd be, compliance. I take that.
I would say that, one of the interesting things on that is some people take differing views of that. Some say, well, because of all these regulations, only the biggest banks are going to be able to, deal with all of this ultimately, and they have a subsidy for too big to fail, so that's where you should go. I would probably go on the opposite side of that. I mean, it's just sort of when you ultimately there is some relationship between the price to book multiple of a bank and the return on equity it's going to generate. And if you start increasing, the denominator on that and sort of saying that the equity base to the assets is going to have to be above 10% and conceivably approaching 15%, I think that's going to really pull down the return on equities. And so I think where an opportunity is ultimately there's going to be a lot of places that assets that the banks are not going to want to hold on to, they're not going to want to be a part of because it's very expensive from a capital point of view. And I would say, investment banking, most of the larger banks, if you announce that you are scaling back investment banking operations of some kind or another, there's usually a positive reaction in your stock. And so while that part of the industry has been under pressure, I think for those who can exploit it, ultimately it's going to be an upside. And we are long Leucadia, and I think Jefferies staying below the CFI $50 billion target over a longer period of time is going to be a tremendous advantage for them. And when you combine that, with the fact they're not going to pay any taxes for a long period of time, a pre-tax return of 15% is going to be close to their after-tax return. And there's some of the investors I know in here who focus in on business development companies who are trying to exploit this, the space that's going to be left by the largest banks. I think there is going to be a better opportunity for outsized returns there versus holding excessive capital levels and then, have the risk of what's next on, what part of the business do they hate, that was sort of alluded to in the Jamie Dimon letter.
Okay. I was gonna, after what I'm about to say, both Tom and Sean will stop talking to me. But I think the regulations cannot prevent future financial crisis, but if you make the life of big banks miserable, then you're probably not going to have the big banks will shrink, which I think is going to be great for the economy, because the problem is that because
Now I really will stop talking to you.
There was I really encourage everybody to read this book called Anti-Fragile by Nassim Taleb, and he basically argues that banks should be just regulated just like utilities. And so when you have financial crisis, the problem is with big banks. If, God forbid, Wells Fargo has a problem, then if it tries to liquidate assets, it's going to create tremendous problem for the economy. So what the regulation does, unfortunately, it makes makes life of big banks very difficult, but also lives of very small banks. Okay, you would want to live in an economy where you have a lot of small banks, because if they fail, they have no impact on the economy. Okay, the economy can absorb it. It's when the big banks fail. So I would argue for greater regulation of bigger banks, not because the regulation is going to do anything. It's not going to prevent the crisis. It's just going to make their life so miserable that they're going to start splitting up. So,
well, I'll still talk to you.
Okay.
I have a few colleagues here, but none of them are in compliance, so I can speak. I think what Jamie's addressing, I understand, but I don't think necessarily big banks being the last provider of liquidity worked the last time around. So I don't have the same concerns maybe that he does on that. And then I think what developed, and this kind of ties into what Buffett's recent letter, he said, the ABCs of business decay are arrogance, bureaucracy, complacency. And it was the arrogance maybe of some of these banks that led to the bureaucracy. And once you get that bureaucracy in your house, you can't get it out. And it's not a fun thing to live with, and it does kill productivity. It doesn't help the economy. So at some point, from a policy standpoint, you do need to punish the bad actors. You do need to protect, kind of have a safety net, but you can't have it to such a degree that it slows the flow of capital, which slows the growth of the economy.
Yeah, you can't keep changing the rules. They don't know how to operate, and that will just restrict banks that provide the lubricant to the economy. You see it in China now. They're cracking down on corruption. People don't know how to do business because of it, and it's clogging up the economy right now.
I think this is a great point at which to thank you. I'm sorry. I would invite anybody that has additional questions to come forward, visit with the panel. I know they'll be happy to stay and answer questions for as long as you have them. We do know that there's something going on at Borsheim's and other places around town that many of you would like to get to. We did promise we would close at 4:30. We're very close to that. I want to thank, first of all, the panelists for doing just a marvelous job today.
You did a great job, Patrick.
And I want to thank all of you for your attendance, for your good questions, and enjoy the Berkshire weekend.